Okay, so welcome guys to the 2026 March Advanced class where I teach you guys the technical strategy that I trade with. Now, I guarantee you guys one thing. I'm going to make this as simple as possible, put in a way that is easy to understand, teach everything that has to do with this strategy to a point where you won't have difficulties trading it. But all I need from you is your attention, your patience to actually just focus on what is being taught. Don't try to run faster than your shadow. Anything that I don't include in the strategy, just know that I will don't use it. Understand? This is it. I broke down the system to a very simple molecule that and even a beginner can understand. So we're going to take the first session, second session, third session, fourth session to do the entire strategy. Then the fifth session will be solely just for questions. So as I'm teaching, save your questions. The class is always recorded. So once you're done with the classes, once I send the recording, you watch it, jot down the questions that you have. When we're done with the entire topic, you collectively go through every material that I sent for the recordings. Then any questions you have, and I'll bring it to the fifth class. That will be the question and answer session. So people make mistakes of after one class, they start analyzing trades and sending me setup that I yet to play out, asking me, is this correct? Is this correct? So they can take the trade and then hit SL or TP without they've just had one class. They don't know the liquidity, they don't know what to place take profit, they don't even know the other POI, they don't know nothing, just the first topic. They're already feeling like pro traders, mailing and sending trades telling me if it's correct or not so they can know you don't do that. Focus on learning. When we are done, use at least a week, 2 weeks to back test and everything. The questions will be hard and that's the best way to learn. Don't be faster than your shadow. So without further ado, let's get straight into it. So the strategy that I trade, eh, well, there's no name because I didn't learn it from anybody. It was basically from back testing the charts and forward testing, but call it SLP. Structure, liquidity, point of interest, and directional bias. Market structure, liquidity, point of interest, and then directional bias. First of all, we're going to talk about market structure. Market structure is defined as the basic pattern of market movement, the current flow of the market. That is what market structure is all about. The pattern in which market chooses to approach one level in price or another is what market structure is all about. So if you see Bitcoin at 90K, then tomorrow you see it at 60K. The pattern or the flow in which price moved from 90,000 to 60,000 is what market structure is all about. It's basically the current flow of the market. That is what market structure is all about. Now, there are three basic patterns of market movements. You open up your charts, markets either doing either one of these three. There's no way you open up your charts and markets not giving you either one of these three. The first one is under trending market. The first two is under trending market. The first one is the uptrend, which is the market giving you a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. This is what the first type of market movement in regards to market structure, which is the uptrend. Second one, under the same trending market, which is the downtrend, but market is giving you now. Most of you may ask why I'm actually drawing out these patterns is because everything that we trade all revolves around this pattern of market movement. There's no way you can get the concept of market structure without understanding the basic movement of the market. Is with how the market moves that you're able to get whether you're trading a reversal or a continuation trade or looking for buys or sells. You need to understand the basics of what the market movement. That's why I said initially the class is not for beginner traders. So first of all, you need to understand the basic movements of the market, which is what the uptrend, the downtrend. The downtrend is basically market giving you a series of lower high and lower low, lower high and lower low, lower high and lower low, lower high and lower low. This is the second pattern of market movement, which is the downtrend. Then the final one is what you call a ranging market, or most people call it a consolidation. It's basically when the market is not trending to the upside and is not also trending to the downside, it's basically just ranging at a fixed standpoint. Something like this, you see price move from the support level to your resistance level back to support. It may not be on the same line, but it's going to be on the same zone. And if you check with the uptrend and the downtrend, you can tell whether market is bullish or bearish because if you draw out your vertical line to the upside, you can literally match that market is going to the upside. And if you draw out your line to the downside, you can tell that market is turning to the downside. But with the ranging market, you can't tell whether market is bullish or bearish because it's going to be moving on a horizontal pattern, which means you cannot really tell whether market is buying or selling at that given moment. So these are the three basics of market structure, the three basic patterns that price makes its movement with. The first one is the uptrend. All right, I'm back. Sorry, I had to get something checked out. Can you guys hear me? Can you guys hear me properly now? I had to get something checked out, so I'm going. Okay, good. Okay, so let's start again. So I said that market structure is the basic flow of the market, the current flow of the market, the pattern in which price approaches one level in price or another. Then I said there are three basics of market movements that there's no way you open up your charts that market is making a movement that is not either one of these three. First one is the uptrend, which consists of market giving you a series of higher highs and higher lows. The second one is a downtrend, which consists of market giving you a series of lower highs and lower lows. The third one is a ranging market, which means market is consolidating between two standpoints, two fixed points. The first one is a support level, second one is a resistance level. So it's basically bouncing from the two. Under the trending market, you can tell whether market is bullish or bearish with the kind of trend that it gives you, whether it's the uptrend or the downtrend. But when it comes to the ranging market, you can't really tell the particular trend at that particular moment because market is going to be bouncing from the support level down to the resistance level. So the three categories, the three patterns of market movements all revolves around two categories, the trending market and then the ranging market. Trending market being the consisting of the uptrend and the downtrend. The uptrend basically signifies a bullish market. If the market is buying to the upside, it's going to be giving you a series of higher highs and higher lows. And if the market is selling to the downside, it's going to be giving you a series of lower highs and lower lows. Meanwhile, the final one is the consolidation. You can't really tell whether the market is bullish or bearish. You just know the market is moving at two fixed points. Hope you guys are following me up. All right. So these are just the basics, the basic introduction to market structure. Now, there are actually two things that we look out for when it comes to trading the structure part of our strategy. When it comes to market structure, there are two fixed things that we look out for when it comes to dealing with when we're dealing with market structure. The two things that we look out for, the first one is called the concept of reversals. The second one is called the concept of what continuations. Now, mostly what I trade in regards to market structure, I focus more on trending markets, which means I always want to see markets in one direction. Either it's bullish or it's bearish. When it's a ranging market, I tend to ignore the markets most times because a choppy ranging market will most likely take you out a lot of times if you don't understand how to trade it properly. But a trending market is actually easier to trade. That's why everything that I trade majorly all focuses on trending markets. So under trending markets, there are actually two things that we'll pay attention to for the trend to give us. The first one is what? A reversal. The second one is what? A continuation. Not the two at a time. Either one of the two can suffice. This is what I mean. If you have market on an uptrend and it's giving you a series of higher highs and higher lows, at this point, there are only two things you can expect the market to give you. Either price continues this uptrend and starts buying to the upside, or at this level, it fails and starts selling to the downside. If it should continue the uptrend, that is the concept of continuation. If it fails and starts selling to the downside, that is the concept of reversals. Same thing, if you have a downtrend and at this level, because it's a series of lower highs and lower lows, at the lower high, there are only two things you can expect market to give you at this level. The first one is either market continues the downtrend or it reverses to the upside. If it continues this downtrend, that is the concept of what? Continuations. And if it starts buying to the upside, that is the concept of reversals. The concept of reversal. So there are only two things that we'll focus on when we're dealing with market structure. There's only two concepts. The first one, the concept of continuations, and the second one, the concept of what? Reversals. So here is what the reversal concept. So it's just like this. You're making a journey from now. There are two things that one. There's something I want to let you guys know. When it comes to trading market structure, we trade continuations more times than we trade reversals. Let me show you how. If you have the uptrend, if you have an uptrend, a market is giving you higher highs and higher lows, 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 higher highs. Then at this level, instead of continuing, it fails and starts selling. Let me tell you the only time that you got a reversal concept. The moment price kept buying from this level, this buy, this buy, this buy, and this buy, all these are continuation entries. But when that price sold from this level, this is where you now got your reversal entry from. So if you count it, you notice that you traded continuations 1, 2, 3, 4, and you traded reversals just one time. So it means in the concept of market structure, we trade continuation concepts time than we trade reversal concepts. Reversal trend or at the end of a current trend. If market has been selling for a long period of time, that sell, as long as you're looking for trades to sell more, you're looking for continuation entries. But the moment market stops selling and you want to start looking for buys, the first time that price will reverse from the downtrend to an uptrend, you're going to look for a reversal concept. So reversal concept is very few times. The moment price wants to end the current trend or market wants to be in a new trend. But a continuation entry is traded more times because to trade continuations, it means you're looking to trade in the same direction as the current trend of the market. So for example, if we have a downtrend, you have lower high and lower low. The market pulls back to give you another lower high to sell. This will be a continuation entry. At this lower low, your market pulls up again to give you a lower high for more sales. This will be a continuation entry of the current sell. If market pushes down, up again, lower high to sell, here would be another continuation entries for more sales. But the moment that price comes there, and instead of doing the same thing to sell, it just starts buying to the upside. That means a reversal concept occurred here. But if you notice that we traded continuations 1, 2, 3 times, but reversals just once here. And the moment price becomes bullish again, let's say it buys and becomes bullish, the moment you start looking for more buy entries, like the market pulls down again and gives you lower high to push up to gives you a higher low to push up to a higher high. That means you trade continuations here again. If it goes up again, higher low for higher high, here will be another continuations for the buy. Higher low, higher high, here will be another continuations for the buy. But when that price comes here, and then instead of buying more, it starts selling to the downside. That means a reversal was caught here. So I will mark the reversal with this box and this box. Meanwhile, these ones here are the continuation entries, the ones with this line. The ones with this line. So reversal concepts are mostly traded at the start of a new trend or at the end of a current trend. In fact, when a current trend is ending, a new trend is going to start. So we had this downtrend. As long as we are looking for trades to take more sales for the downtrend, we're going to be looking for continuation entries. But the moment you want to stop looking for sales and the market is about to start buying, before that buy will occur, you have to get a reversal concept at the zone where the buyer wants to start. So here will be a reversal concept. The moment you've gotten that reversal concept, the market is now bullish. Provided you are going to look for more trades in that bullish direction of the market, you will focus on looking for what continuations. So it's just like this. Let's say you go from Lagos to Abuja every day for your job. So you go from Lagos, you stop at Abuja, then from Abuja, you are going back to Lagos. That's the normal routine. The moment you move from Lagos and then maybe you go from Lagos and after 1 hour you decide to have a rest. That rest, let me just take it. Let me put it down to the normal understanding of what we all went through, except for the nepo babies. If you take bus or public transport, yeah, the bus, the train, the public transport, and then you leave your house and then you stop at the bus station. You board the bus and you go for like 1 hour. After you went for 1 hour, there's normally a wait period where people come down from the bus station, they buy food, they eat, and the rest. Let's say that eating is what they pull back down here. After everything, the bus will still start moving to your destination. After like an hour, you guys will stop. Most people will come down to pee. Most people will come down to ease themselves and the rest. After that, you continue moving back again to your direction. Let's assume this is the final destination. Yeah. The moment you keep having your stops and the rest, that is this pullbacks, that is this continuation entries. But if you get to your final destination, the bus will load another passenger that will go back from the place you stopped to the other side that it came from. So let's say it loads those new passengers at this zone that's going back to, let's say you came from this, let's say this is Lagos and this is Abuja. From Lagos, all these stops are continuations. You stop, you pick up a passenger, continuation. You stop, pick up a passenger, continuation, till you get to your final destination. The moment you go to your final destination, you changing directions from the current place that you are to load to another, to back to the zone you came from or to another direction, that is where you will get a reversal. This reversal basically means at this junction, I'm done for this particular move and I want to change directions to the opposite side. Now, the moment you get that, the process will repeat itself again. Each stop that you guys make for resting and the rest will be a continuation move for more moves in your direction, right? Each stop you make will be a continuation move to more moves in your direction. Each stop you make, continuation move to more moves in your direction. Let's say you get to this zone again and you offload all the passengers. Then you want to move back to this other direction. You get another reversal entry here. So that's basically, I hope you guys are understanding my analogy. You guys understand what I'm trying to explain? Yeah, so that's the whole concept of market structure, reversal concept and continuation concept. So the moment you are looking for trades in the current direction of the market, the only thing you should focus on is looking for continuation entries. But the moment that price wants to change directions from one direction to another, you have to get continuation reversal concept. So like for example, let's say this whole BTC sell. The whole time that BTC was selling, if you are to look for more trades in the direction of the current sell of the market, you'll be expecting continuation entries. But the moment that BTC hits this zone and then started buying to the upside, before it bought, you will get a reversal entry here. Now, the moment that the buy is already active, if you're looking for more buys, you have to now start focusing on what continuation entries again. So basically, what I'm trying to explain is that the moment you are looking for trades in the current direction of the market, focus on continuations. The moment you know that price is about to change directions from the current direction of the market to the opposite side, that is when you should be expecting reversals. Somebody shout power. You guys are following me up, right? You're following me up, shout power. It's like this is like the word of God, but in regards to charts. So that's basically what I'm trying to explain to you guys. But the thing with reversal concept is that you don't just expect reversals at any random place. It's just like I use the analogy of the transportation thing. You don't you don't board a flight from Lagos to Abuja, then the flight goes halfway and just turns and goes back to Lagos without getting to this destination. No, there's a particular zone you will get to before you expect a change in direction, before you expect a reversal to come in. So, for example, it can be from maybe this zone to the next zone in the market. So, if it moves from here, you expect it to be on continuations until it gets to this level before you can see a reversal to the opposite side. But you don't expect market to go halfway, then stop and start reversing to the other side, except you're not trading in the right direction of the market. Remember, there's one thing we call directional bias. We're not going to deal with directional bias in this class. Talk about directional bias in the next class. But for now, I want to just give you guys a sneak peek of what I'm trying to say. What I mean is that for reversal concepts, there are zones where you expect reversals to come in. It does not just happen at a random place. Every zone that market in this direction is most likely a daily time frame point of interest. Is most likely a point of interest that came from a daily time frame. For example, I will show you guys all the zones that are price change directions. I will show you the zones. So, for example, this is a zone that market change directions. from the sell that it was on to this buy. If you check the zone where it happened, you can see that on the daily time frame, it is what? An order block down here. This is it. This is it. And you check again, the zone that price also bought from, even if it's a temporal buy and not like a permanent buy, you go into this zone, then it bought to the upside. This buy that happened here, a reversal concept happened at this level. If you check, it did not just happen at a random place, it was a daily time frame order block. Same thing, there was a sell that market gave us, but when it came to this level, it reversed to the upside. This reversal that it gave us means that there was a reversal concept that occurred at this level, but it's not just a random place, it's what? A daily time frame breaker block. Same thing again, market was selling to the downside and then it bought from this level and reversed to the upside. That means that a reversal concept came in play here. But it's not just a random place, the daily time frame breaker block. I want to talk about these things in more details in the directional bias class. But for now, I'm just trying to explain to you guys that you don't just expect a reversal concept to happen at a random place. Most times, it will always happen at a daily time frame point of interest. Daily time frame POI, that's mostly when you expect reversal concepts to happen. Or at a point of interest, like an order block that has a large candle enclosure. What I mean by that is that there are some OBs that the candles are extremely large. Whenever price hits those OBs, it most likely will give you an extra layer of confirmation by giving you a reversal concept when it hits that POI. For example, this is an example of what I mean. This is another block with a large candle enclosure right here. So because the stop loss is going to be extremely large, most times our price will hit these levels. It will give you an extra layer of confirmation by giving you the reversal concept when it hits these levels. So there are two certain zones that I'm very sure that price can give you a reversal concept from. The first one is daily time frame points of interest. By daily time frame points of interest, I mean a daily time frame order block and a daily time frame breaker block. Most of you don't know what a breaker block is yet. Most of you don't know what an order block is yet. So I'm going to explain that when we talk about the point of interest part of the strategy. But I'm trying to tell you guys that for reversals, the reason why we trade reversals few times and continuations more times is that the zones where reversals come in are specific zones. So before price gets to those levels, you are mostly going to focus on continuations of the current trend until your price gets to the levels where you are expecting the reversals to come in. So for example, if the levels you're expecting the reversal to come in is down here, and market is currently at this level and is selling down, that means because it's all the way down here, you are going to focus on continuations of the sell until the price gets to the level you're expecting the reversal to come in. And when the zone gets hit, this is when you now expect that reversal to happen. So if market should give you that reversal concept, then you are now bullish. And if you are bullish, you are now going to focus on what? Continuations of what? The bullish move. No longer reversals, but continuations of the bullish move. Until price gets to another zone where you expect another reversal. Let's say the other zone is what? An order block here on the daily time frame at this level. So market is going to be bullish, continuations of the bullish move, continuations of the bullish move until price gets to the level where the reversal may come in. And if it gets to that level and then gives you the reversal concept, that means you're not going to be what? Bearish. So the reversal concept will come in here and then it will come in here as well. But the moment you get that reversal concept, moving forward, you now focus on what? Continuations of what? The current trend. So at this level, continuations of the current sell. At this level, continuations of the current buy. At this level, continuations of the current sell. So when we're talking about directional bias, I will explain the zones where we expect these reversals to come in. But for now, I'm just going to give you guys a glimpse into those zones. Basically, just this explanation. But when we'll explain more POIs and then the rest of the strategy, we'll talk about directional bias. So you now understand when to expect these reversals and where to expect them from. Hope you guys are following me up. So now let's talk about these concepts that we trade reversals and continuations with. So first of all, we're going to talk about the reversal concept, and we're going to talk about the what we trade the reversal concept with. So what we trade the reversal now, for example, now we check something. Wherever this reversal concept will come in are these daily time frame zones that are marked out. So we see these zones, I marked them out with this blue box. So you notice that I'll go to those levels to spot my reversal concept. So you don't start looking for reversals as any random place. All these zones are marked on the daily time frame are the zones that you expect your reversals to come in. Daily time frame. And the recent buy on BTC, I'm very, very sure that you guys saw it because I posted it on X. That buy, I will show you guys how I got the buy as well on the daily time frame order block. So I told you guys the reversals will come in at daily time frame POIs, whether the order block or the breaker block. In directional bias class, you guys will understand these zones very well. But for now, I'm telling you that the only zones that I would expect reversals to come in are only two scenarios: daily time frame POIs or POIs with large candle enclosure. That is mostly other blocks that have a large body enclosure. So I would expect. So I will show you guys how I expect reversals at those levels and how what I actually look out for to get a valid reversal concept. So first of all, I told you guys that a reversal is basically an indication that the current trend that market is on is ending and a new trend is about to begin in this opposite direction. A reversal concept is a scenario that indicates that the current trend that market is on is ending and the new trend is about to begin in its opposite direction. And how you can identify a reversal concept is with what we call a market structure shift. A market structure shift is basically a scenario where price deviates from the current pattern of the trend that is on. This is what I mean. A downtrend is known for lower highs and lower low, lower high and lower low, lower high and lower low, lower high and then lower low. Now, a deviation of the current trend means the moment price stops giving you lower highs and lower lows, that means the market has now changed or deviated from the pattern that makes up a downtrend. So first of all, before you expect that reversal concept, market needs to hit that daily time frame POI you had marked out, or that other block that has the large candle enclosure before you start looking for your reversal concept. So first of all, you have to have the zone marked out already and waiting for price to approach it. So when price hits that zone and then deviates from the pattern that makes up that trend that is on. So this is what the zone already hits. Now the pattern that makes up a downtrend is lower highs and lower lows. The moment price gives you anything that is not lower highs and lower lows, after hitting the zone, you're expecting the reversal to come in. That means that the market structure shift just occurred at that level. So if market does something like this, when it hits this zone, instead of maintaining the downtrend by giving you another lower high to push down to give you another lower low, it does something like this instead and takes out this last high and closes above it with a body candle. The moment this happens, even if it's just the slightest close above the zone with a body candle, that is what you call a market structure shift, MSS. Same for it being on a downtrend. So let's say this is the zone you expect the reversal to come in. You have market on a previous uptrend giving you a series of higher highs, higher lows, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. It triggers the zone you expect the reversal to come in. But remember, the zone is what? Daily time frame POI, daily time frame point of interest, or an order block with a large or a POI with a large body enclosure. When it triggers the zone, there are two things you expect the market to do. If market continues giving you lower high, sorry, higher low, and then higher high, it means this zone is not going to hold for the reversal. But if market fails to give you that, and then instead of giving you that, it does something like this and takes out the last low that market made and closes below it with a body candle, that signifies a market structure shift. This tells you that market is going to change directions from the previous trend, which is this previous uptrend, to now a downtrend. So the concept of reversal is related with what you call a market structure shift, and how you can get it is what? When price deviates from the current pattern of the trend that is on. If you guys are following me, or somebody shout power. If you're following me, or shout power. So that is basically what a reversal concept is. So from these examples, from these zones that I marked out, I'm going to give you guys this scenario. So we have market on a downtrend, right? Towards the end, you can see the lower high and then lower low, lower high and the lower low, lower high and the lower low. The zone we marked out have not triggered yet. Give us a lower high and the lower low. It triggers the zone. At this level, there are only two things that can happen. The first one is that market continues the downtrend by giving you another lower high to sell to the downside. That's the first scenario. The second one is what? So if the first one should happen, that is the concept of what? Continuation. So you're continuing the current trend. And the second scenario, it's what? It starts buying. And for it to buy, it needs to give you an MSS, which means it needs to buy and take out the last high that market gives you to close above it to the body candle, which means that an MSS occurred at this level when price hit that zone that we marked out that we're expecting a reversal to come in. So this is what the market structure shift. So first things first, you have to know the zone that you've marked. You have to have the zone that you already marked out that you are expecting a reversal to come in, which is what? A daily time frame point of interest. That is the first thing. Secondly, when price hits that zone, don't jump into the market yet. Wait for a reversal to come in. Remember, the reversals happen when market is on a particular trend for a long period of time and we're expecting a change in direction. If you notice, price has been selling for a long period of time. Then we're expecting a change in direction, so market to start buying. That was why I was expecting the MSS to happen at the level I marked out. But if I was not looking to sell, I would have just been focused on looking for. If I was not looking to start buying, I would have focused on looking for continuations of the sell and found a way to take more sales to the downside. I would have looked for a sell at this level here. I would have looked for a sell at this level here. I would have looked for another sell at all these levels. All these pullbacks the market gives, I'm going to be looking for sales at those levels. But because I was looking for, I know that market is going to start. Well, when we talk about directional bias, you guys will understand why. I wish I could skip to directional bias, but I cannot. So, because I want you guys to understand what I'm trying to explain in terms of directional bias. But you just have to understand something like just like this. Let me just give you guys a small instance. Overall, on the daily time frame, you have a bullish market, right? And the bullish market is made up of higher high and higher low. This is daily time frame. Higher high and higher low. Higher high and higher low. The places that you expect reversals are what? This zone that market gave you this higher high before the sell that triggered the higher low came in. You get a reversal here, you get a reversal here. Price pushes up. Another zone you get a reversal is what? Here, where market gave you the higher high for sales to come down here, for more buys to come at this level. This is what another zone you get a reversal. At this level, you get another reversal. At this level, you get another reversal. So the buy is the overall trend. The sell is the correction. The zones where the impulsive overall trend comes in, and the zone where the correction comes in, are the zones you likely expect reversals to come in. So this trade now is the zone that the correction reversal came in, and this zone, the zone that the main trend reversal came in, is overall bullish on the daily time frame. This was just the MSS that triggered market to sell to this side for more buys to come in. So both the MSS can be traded. If you notice, if I wanted to trade the MSS for this trade, I would have done this. This is what? An uptrend. You can see a whole lot of higher highs and higher lows, higher high, higher low, higher high, higher low. Then eventually price took out the last low, closing below this zone and giving us a market structure shift. This was the signification that market will sell to the downside. The sell sold all the way to the next level where another reversal came in for more buys to happen. So that's basic directional bias. You guys will understand this very well. But I just want to let you guys know that there are zones where reversals are meant to come in. When the reversals comes in, whatever direction that the market gave you a reversal into, you now have to focus on looking for continuations to find more trades in that direction if you are to look for any more trades again. So when price hits this level where I was expecting a reversal to come in on the daily time frame, it gave me my market structure shift by taking out the last high and deviating from the current pattern of the downtrend that it was previously on, which means the downtrend was previously lower highs and lower lows. The moment it came here and gave me a higher high, taking out the last high and closing above it with a body candle. That was where I got my market structure shift. Same thing as this scenario here. I marked out this level on the daily time frame, which means when price hits this level, I can also expect another reversal entry here. Now, towards the end of the move, market was giving us a series of, you can see lower high, you can see lower low, you can see lower high, you can see lower low, you can see lower high, you can see lower low, you can see lower high, you can see lower low, lower high, lower low. It has not triggered the zone yet. Lower high, then this lower low triggered that level. So at this level, there are only two things we're expecting the market to give us. Either it continues the downtrend by giving us another lower high and then lower low. That means the zone will not hold. Or it respects the zone by giving us a reversal concept at that level. The reversal concept means the last high the market gave us here, because it was a downtrend, the market needs to take out that high and close above the high with a body candle, even if it's the slightest. But as long as it does that, that is a market structure shift. And that was exactly what market did when it triggered this zone, giving us a market structure shift by taking out the last high and closing above with the body candle. Hope you guys are following me up, please. Now, this is another reversal entry. I'll map out another one here, the one with the market triggering the zone with a large body enclosure. If you check, this is an order block, yeah? I marked out the order block. Before price approached the order block, it was giving us a series of lower high, lower low, lower high, lower low, lower high, lower low, triggers the zone. So at this level, there are two things I'm expecting. Price will give me lower high and lower low and continue doing that until this zone gets taken out. Or give me a reversal concept by taking out the last high and closing above with the body candle, which is what market did exactly. When it took out the zone and closed above it with a body candle, that's what you call a market structure shift. Now, these reversals are a one-time thing. The moment I've gotten a reversal concept, moving forward, as long as so the reversal concept is to the upside, that means market is now officially bullish. Anytime that I'm looking for more entries to buy, I will no longer be looking for reversal concept. Instead, I'll be looking for continuation concept. We've not talked about the continuation concept yet. We're going to. So the the reversal concept. I will check again for another zone that I marked out, which is down here. Check down from course. Wait, time from course not clear on the other time. So yeah, this is it here. I marked out this zone, daily time frame order block, but market was selling to the downside. Now market was giving us a series of, you can see it, it's been bearish. Towards the end, you can literally see a clear lower high and lower low, 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 triggers daily time frame order block that I marked out. The next thing it did, either the market continues, the two scenarios, either it gives us what continuations by doing the same thing, lower high and lower low and selling to the downside, or a reversal by taking out the last high and closing above it with a body candle. It chose the scenario two, which is the reversal concept at this level. So when it gave us that MSS, that signifies that market is about to change directions from the downside to the upside. So this is what the concept of reversals, the market structure shifts. Somebody shout power. Also, this is it again. Now remember I told you guys that when price triggers an order block with a large candle enclosure, that it mostly gives us another reversal concept as an extra confirmation. Now, if you guys notice, this order block has a large candle enclosure, right? So not only do we also catch the reversal concept here, we can also catch another reversal concept when that zone triggers. If you notice, towards the end, price was giving us a series of what? You can see it, lower high and lower low, lower high, lower low, lower high, lower low, lower high, lower low. Remember, and a POI with a large candle enclosure. Because it's large, we'll probably expect another reversal concept before price continues pushing up. So when price hit this zone, what do you do? Took out the last high, which is here, and close above it with a what? A body candle, which means we got our MSS at this level, right? That was what required the extra layer of confirmation. That was why eventually price came back there again, because the POI had a large body enclosure. That was why we had an extra layer of confirmation when price hit that other block. So we've already gotten the MSS here and we had the POI here. Most people can enter from the POI, good. And you can also get another entry again when price hit the POI and then give you the reversal concept again. Also good. So what I just marked out for you guys are the two scenarios where you expect a reversal to come in. When price hits a daily time frame point of interest, or it hits a point of interest with a large enclosure, a large body enclosure, a large body candle. That's when you expect reversal concepts to happen. Hope you guys are following up what I'm explaining, right? So that is the reversal concept. The reversal concept that will trade few times in the market. That is what the reversal concept that will trade few times in the market. Now let's talk about the other concept of market structure, which is the continuation concept that will trade more times in the market than will trade the reversal. So remember, after you get the, remember, it's structure, liquidity, points of interest. It means after structure, you look for liquidity, then you get for point of interest to get into the market. That is it. So that makes a full complete setup. A full complete setup requires you to see the structure part of it, the liquidity part of it, and then the point of interest part of it for it. So after you've gotten this structure, which is the MSS, the structure requires two things. Either you get the MSS, that is for reversal, or you get the one for continuation. After that, you get the liquidity, and then you get the point of interest when you get into the market. That is what a full complete setup is all about. Now, after that, that means, so in a scenario where you get a reversal concept as the structure part of the strategy, that means the moment that price completes the full setup, moving forward, if you're looking for more trades in that direction of the market, you have to now focus on what? The continuation entry. So let's assume this was where, I'll tell you guys why market bought from this level, but this was where the full complete setup met for this particular MSS, because this was where market started buying after it gave us the MSS, started buying from this level. I'll explain why. But I want to just tell you guys, this a full complete setup is the one that meets all these requirements of our strategy. Structure, liquidity, point of interest. We have the structure, liquidity is also here, and the point of interest is the zone that the market started buying from. The full complete setup is already done. Now, to find more trades in the current direction of the market, because we already got the MSS from this downtrend to now an uptrend, the full complete setup is already where market triggers this zone for the buy. Now, to find more trades in the new direction of the market, which is what? This buy, that is when you now focus on what? Continuation entries. So the reversal entry was for this changing direction from this downtrend to the uptrend. Now you've completed the setup by getting the zone that market started buying from down here. The moment, let's say you missed this first zone and you're looking for more trades in the uptrend, the current direction of the market, that's when you start looking for continuation entries. So now, the concept that we trade continuations with is called a break-of structure. Not just any break-of structure. I use what I personally, myself, backtested, and I call it multiple break-of structure. So first of all, let's talk about break-of structures. A break-of structure is a scenario whereby price keeps breaking a key level while maintaining its current trend. For break-of structures, markets will maintain the current trend of the market, but it will keep breaking levels. By levels, I mean highs and lows in the market. For example, if this is an uptrend, higher high and higher low, higher high and higher low, higher high and higher low. Notice two things. It's breaking this high. It's breaking this high. And it'll probably also break this high as well. But the other thing you notice is that it's maintaining the what? The current trend of the market, which is what? The uptrend. But if it was a reversal concept, it's going to give you a reversal, but it's no longer maintaining the current trend, which was the uptrend. It's going to now start selling to the downside. So a break of structure is a scenario where price keeps breaking key levels, which is highs and lows of the current structure or whichever one, while maintaining the current trend of the market. So if market is bullish, it will keep breaking the highs of the bullish move while maintaining that bullish move. That is what makes up a break of structure. So this is the break of structure when this high gets broken, when this high gets broken, when this high gets broken, when this high gets broken. It's doing all that while maintaining this uptrend. Now that is what you call a break of structure. Now let's get into what we call multiple break of structure because I don't trade break of structures. I trade break of structures, but I need an extra layer of confirmation for the break of structures. So I include what I call multiple break of structure rather than trading the single break of structure. A multiple break of structure is basically when price takes out more than one zone, more than one high, or more than one low. By this, I mean, there are always highs that existed before in the market, before price starts giving you a current trend. Let's say, for example, you had a previous high, or let's say another high here. The market is what? Bullish, giving you a series of higher highs and higher lows, higher highs and higher lows. It broke this high. This is what you call a single break of structure because it's only one high that was taken out in the market. But this, let's say it does something like this again and higher low. Broke this high again. This is what you call a single break of structure because it's only one high that was broken in the market. But what you call a multiple break of structure is does something like this. Now, when market does something like this again, higher high. Now, what's the difference between this recent one and these previous ones? Market did what? It took out this high and also took out this high here as well and closed above the two zones with a body candle. Now, one thing that you will notice is that the two zones is broke. The two highs is broke is different. The first high is broke is the high of the current trend of the market, the high of the current buy. And the other high you broke is the high of the previous sell, a combination of the current trend and then the counter trend. A combination of the recent high of the market, the high of the current trend of the market is this, and then the high of the previous trend of the market is this. A combination of the two of them is what you call a multiple break of structure. So it's just like, let's say for sell scenarios, something like this, you had markets on a bullish move. Then eventually gave you the reversal concept and then started selling. Now to find a double break of structure, this one is a single break of structure because it took out just one low here. Same thing here, one low here. Same thing here, one low here. Taking out just one zone, this low, this low, this low at a time. But if something like this happens and it closes below, let's even say it closes below this one too. It took out this low and also took out this low here as well. And also took out this low here as well. Took out 1, 2, and 3 zones before the candle closed. As long as if you count how many zones, how many highs or how many lows that got broken, and it's more than one, that means it's a multiple break of structure. But also, more importantly, it took out the two lows. That they are lows, but they are different because the first low is the low of the current sell, but the other low that it took out was the lows of the previous buy. A combination of this current trend and a combination of the previous trend getting broken is what you call a multiple break-off structure. You guys following me up? Don't worry, the class is being recorded. Anything that's confusing, you can always watch the recording and. So when price takes out more than one zone, the first zone has to be the current trend, the zone of the current trend, and the other zone has to be the zone of the previous trend. A combination of the two of them getting broken, or three or four, as long as it's more than one. That's what you call a multiple break of structure, and that is what I trade continuation entries with. So let's go to the chart and find it. So the first one I got here is an MSS for reversal concept. So we've already gotten the MSS. Let's say we've already gotten the complete setup for that MSS. Our market is now already bullish. Now, as market is already bullish, to find more trades in that bullish market, you have to look for what you call continuation entries, which is what? A multiple break or structure, which means you have to look for price to take out more than one zone. The first one, the zone of the current trend. We are looking for buys. So we're looking for a high of the current trend to be broken and the high of a previous trend. So if you look, you can see this is the market being bullish, right? That means you have to find the high of a bullish market, which is this high here, is the high of this current bullish market, right? And then for the high of the previous market, of the previous trend, which is when market was selling, all these sales they gave you here, you have to now find the highs that exist in those zones. When the high of the current trend and the high of the previous trend gets broken at a go, that is a multiple break of structure. So if you look at those highs, you can see this high already got broken. This high also is the high of the previous trend. This high also is the high of the previous trend as well. When market broke this internal zone and the two external zones, this is what you call a multiple break of structure. So wherever the candle closes is where you will mark out your multiple break of structure. And you have to make sure that it took out more than one zone. That is what makes up a valid multiple break of structure. So this is the multiple break structure. When that happens, it means that more continuations will come in for more buys to come into the market. The reason why I don't trade the single break structure is that most times when it happens, price may not pull into proper zones for you to take your buy or your sales from. So that's why I focus on multiple break structures, because more time the market does that, it pulls into zones where I can actually take my trades from other block zones or breaker block zones. So this is an example of a multiple break structure. Another example of it is this. If you notice, after price put back here and then started buying again, when it pushed up, it took out this high. But not only did it take out just this high, this one is the high of the current trend of the market, which is what? The bullish move. The high that was made when market was already bullish versus this high here that was made when market was what? Bearish. So this high got taken out as well. Plus, even when market was bearish at this zone, this other high here got broken in. So a combination of this current high, the high of the current trend, the high of this previous trend, this sell, and the high of this sell here, when all these zones gets combined and these zones get broken at a go, that is what you call a multiple break of structure. This is what I trade continuations with. I don't trade continuations with the single break of structures. I trade continuations with what you call a multiple break of structure. Another example of that scenario is here. We already have market on a sell, on a bearish move. So that means we're no longer looking for reversals because it's already selling. To find more entries for the sell, you have to look at market to give you what you call a multiple break of structure, which means when price takes out the low of the current trend, this is the low of the current trend. It's already selling this low of the current trend of the market, right? Even this low, this is it. And then the low of the previous trend, which is the low of our market was what? Bullish, which is down here. The combination of this low of the current trend of the current sell here and this low of the previous buy, what you call a multiple breakout structure. This signifies that more sales to the downside will happen, but before it happens, price will pull into a proper point of interest before more sales will happen. So that is the difference between trading the single breakout structure and the multiple breakout structure. Whenever you get a multiple breakout structure, it's a scenario, it's an indication that more trades in that direction will happen. Another example is this. This is what the low of the current trend, right? And this is the low of the previous trend here. A combination of these two zones getting broken is what you call a multiple breakout structure. That means more sales to the downside would happen after this, which is exactly what market did here. So for continuations of the current trend of the market, we use what you call a multiple breakout structure, whether buys or sells. And for reversals of the current trend, we'll use what we call a market structure shift. Hope you guys are following me up, please. you can do this on or at a large scale. You can do it at a large scale or at a mini scale. The lower, smallest time frame, highest time frame, no matter the one, you can do it at any of the levels. So as long as you can get a combination of the current trend and the previous trend, whether it's a mini one, a micro one, small one, large scale, higher time frame, daily time frame, as long no matter the time frame, as long as you can spot these two, you can trade it. So I've talked about market structure enough for like 1 hour. I've talked. I broke it down to the simplest atom, to the smallest molecule, so that you guys can understand the concept of market structure being two concepts that we'll pay attention to. First one, the reversal concept. Second one, the continuation concept. Reversal concept being the market structure shift. Continuation concept being the multiple break of structure. Now, that is the structure part of our strategy. That tells us whether we're looking for buys or whether we're looking for sales. I have a question for you guys. Let's say you have markets on a downtrend, right? And then you have something like this happen. Then you have markets giving you a series of lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Then this happens. After this happens, what trade are you looking to trade? Are you looking for buys or are you looking for sales? Exactly. We are looking for sales. We are looking for sales because we got a continuation entry for the continuation means trading in the same direction as the current trend of the market. This multiple break of structure here, this low of the current trend and the low of the previous trend. Two of them got broken, giving us a multiple break of structure. That means we are looking for continuations of whichever trend the market is currently on. That is why it's important to understand the structure part of your strategy. Because that is structure, how do you know whether you're looking for sales or how do you know whether you're looking for buys? By looking for continuations, you can tell whether you're looking for continuations of the current trend, which means if market is bullish, you're looking for continuation of the bullish move. If it's bearish, you're looking for continuation of the bearish move. And then if this is what we got, this is what we had. At this scenario, what are we looking to trade here? Are we looking for buys or are we looking for sales? Exactly. So, do you guys see how important the structure part of our strategy is? It's very important because it tells you whether you're looking for buys or sales just by you identifying a simple MSS or a multiple break of structure. Whichever one the market gives you will tell you whether you're looking for buys or whether you're looking for sales. The thing with MSS is that it's traded few times and it has to happen at a higher time frame POI level or at a POI that has a large body enclosure. These are the two scenarios you can get your MSS. But for multiple broker structure, as long as the market is in one direction, you will always get that for more continuations of that trade. So that is the structure part of our strategy. It's time to move on to the liquidity part of the strategy. So you guys should relax before we move on. Calm down, catch your breath, prepare yourselves. Let's move on to the next part, which is the liquidity part of the strategy. So liquidity is basically means money. It basically means the zone where you have money in the market. Prices are trying to go to those zones. That's basically what it means for liquidity to be in the market. That's basically what liquidity means. So wherever there's money in the market, that's what liquidity means. So there are different types of liquidity that we have in the market. There are a lot of them, but the liquidity that we use when picking entries is what we call the inducement. The inducement is a type of liquidity that we use when picking entries. Are you guys following me up? Are you guys following me up? Someone said, can we do liquidity tomorrow? The liquidity is just one, is one type of liquidity. I'm not talking about the entire type of liquidity. I'm talking about just one type of liquidity. Allow me follow my class in the structure that I follow it. Just worry, calm down. We're almost done. Now you guys don't debate. Now me they teach. Now me they talk since when I debate me make I stop the talk. When I me they stress myself the talk. So now the liquidity that we use in picking entries is called an inducement. Now an inducement, get this, is defined as the first valid pullback that market gives us after an MSS or after a multiple break of structure. Remember, I said that first of all, you have to take everything step by step. You understand? You have to take everything step by step. You have to look out for the structure first, then you look out for liquidity second. Even by definition, the inducement is telling you that before you can get an inducement, you need to have gotten an MSS or a multiple break of structure. So the inducement is the first valid pullback that market gives you after an MSS or after a multiple break of structure. First of all, a pullback basically means a retracement. A pullback means a retracement. So let me say something. If this is like a break or structure to the upside, a pullback basically means when this candle closes, the next candle that comes out should give me a retracement to the downside before price starts moving back to the upside. This is what a pullback means. If you have something like this, if you have lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, then you get an MSS to the upside. The moment this candle that triggered the MSS closes, the next candle that comes out, if it gives me a retracement to the downside before price continues pushing back to the upside, that means this retracement that it gave me is an inducement, is a pullback. So first things first, I have to get the MSS or the multiple break of structure first, and then wait for the candle that triggered the MSS or the multiple break of structure to close. Once that candle closes, the first retracement you get into the direction where that MSS came from, that retracement, the moment price gives that retracement and then continues moving back in your direction of your MSS, that retracement it gives you is your inducement. So what I mean by it moving back in your direction is that whichever zone that the MSS candle closes, after the retracement has been made, price needs to go and break above or below that zone, below the body of the zone. That's what I mean. So let's say if this is the MSS to the downside, if you have higher high, higher low, higher high, higher low, higher high, higher low, then you get an MSS to the downside. The moment the candle for the MSS closes, the next thing you should expect is a pullback. A pullback basically means a retracement to the upside before price continues pushing back to the downside to close below the body of the MSS candle. The candle that triggered the MSS, wherever the body of the candle closes, the retracement should proceed to close below it. After that happens, that means that the retracement is now a proper inducement. So this here is an inducement. Here is an inducement as well. So that's basically so our inducement, basically the inducement is a type of liquidity. Liquidity is the general enclosure of these types of liquidity is the general name for all these different types of liquidity. In fact, sorry, inducement is under liquidity. Inducement is a type of liquidity that we use when picking entries. So it's defined as the first valid pullback. Remember, I said the first valid. For it to be valid, it needs to break above the zone where the MSS candle closed or the multiple break of structure candle closed. This is what I mean. So this is a multiple break of structure. Higher high, higher low, higher high, higher low. Multiple break of structure. The candle has closed here. It took out this high and then this high. You've already gotten the multiple break of structure, right? The pullback being the inducement, for it to be valid, it needs to give us a retracement, first of all. Then, secondly, proceed to take out the body closure of this zone that the multiple construction to close that. That is what makes the pullback a valid inducement. So, here would be your inducement. Are you guys following me up? The body needs to close above, it needs to close below or above the MSS candle. If it does not, you have not gotten a proper inducement yet. If it does not, you've not gotten a proper inducement yet. Let's check one of the examples here. The first example here, we got the MSS, right? This is the zone that the MSS candle closed. After that, the next candle that came out gave us a retracement to the downside, but it could not break above the MSS candle. That means I've not gotten an inducement yet. The next candle that came out did the same thing. It broke above it, but it did not close above. It closed below. That means I've not gotten an inducement candle yet. After that, the third candle that came out now gave us retracement and then eventually pushed up and closed above this MSS candle. It was after this happened that I can now pick any retracement here, whether this one or this one, as my inducement candle. So that is when I can now pick an inducement. The moment a retracement has been gotten and then price takes out the body closure of our MSS candle or the body closure of our multiple broker structure candle, that's when I can now mark an inducement. If I've not gotten that break to this MSS, if I've not gotten my MSS candle getting broken, I will not mark an inducement. If the next candle that came out stops here, another one comes down here again, I've not gotten an inducement yet. Eventually, if market now does this and breaks the high, that's when I can now mark my inducement. So I must not mark the inducement if the body closure of my MSS candle or the body closure of my multiple break structure candle have not yet been broken. I cannot mark my inducement yet until that happens. Now, remember, the inducement can also be a single candle wick, what you call a single candle retracement. When that happens is when it was just the week that market gave you after your MSS before the body closure of your MSS candle got broken. Or if you notice, in this first example I gave, price gave us multiple candles before it broke that MSS candle, which is why it's not just a single candle that is our inducement. But there's some scenarios where price will give you the MSS or the multiple break of structure. Then the next candle that comes out gives you an inducement and then proceeds to break out the MSS candle or break the multiple break of structure candle without giving you other candles. That single candle wick can also be your inducement. In this scenario is here. This is our multiple break of structure here, right here. This is the candle that triggered the multiple break of structure. This is where the body candle closed, right here. After that, the next candle that came out gave us a retracement to the downside. It gave us this retracement to the downside, and then the next, after giving us the retracement, it pushed up immediately and then broke above this multiple break of structure candle closure here. So when that happens, the retracement it gave us becomes an inducement, which is this retracement here. So it took out the body closure of our multiple break of structure candle without more candles being shown here. Market did not give us more candles did not get produced before our structure part of our strategy got broken. So the zone will mark the multiple break of structure. After the inducement was made, price broke through the zone immediately without more candles being made. So we can just mark out this single zone as our inducement because the moment it gave us a retracement, it took out the body closure of our candle. So this is what our inducement here. Do you guys understand what I mean? I said there are times where a single candle can be your inducement. The first example I gave, they said this can happen. They said this is an MSS. Then after the candle closes, this is the body closure of our MSS candle. Then the first candle gives you a pullback, goes up again, gives you another pullback again, more moves happens to the downside before price eventually pushes up to the upside and takes out this body closure of our MSS candle. You can mark this as your inducement. More moves exist here, but it's still a pullback. Something like this this is your inducement here. Proper inducement. This can also be an inducement. Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. MSS. The candle for the MSS closes. The next candle that comes that gives us a pullback, but it does not close below here. It just pushes up immediately and takes out this zone. This pullback, this candle week can also be an inducement as well. Our focus would be for wherever the body candle of our MSS candle, wherever it closed, or the body candle of our multiple reconstruct candle, wherever it closed, for the candle to be taken out after your inducement has been formed, after the retracement has been formed. The main doesn't get taken out, whichever retracement that you get, whether it's just one single candle or two candles or three candles, that's your inducement. You guys understand now? So that is the inducement. So um if you notice, so whether it's a single candle wick, as long as after the retracement of that candle happens, the zone where your MSS candle closed gets taken out, that's a proper inducement. So in this MSS scenario, this is the wick closure of our MSS. Down here is the body closure of the MSS. Where this is where our focus is. After the MSS, next candle that came out gave us a candlestick retracement to the downside, which is this, and then pushed up and closed above this body closure, including the wick closure here as well, making this low a proper inducement because it's just one single candle wick that was formed. If more candles got formed, we can pick another inducement. But it was just this single candle that formed before price took out the body closure of our MSS candle, which means it's a proper inducement. Yeah. In this scenario, this is the same thing. Single candle inducement, proper inducement. In this scenario, same thing here. Multiple break structure. The next candle that came out is this candle wick, and then it took out the body closure of our multiple break structure candle, making this low this high our inducement. Same thing here. This one is not a single candle. This one has more candles there. So this is an MSS. This is the body closure of our MSS candle right here. After that, we have a retracement to the downside, and the market proceeds to now break above this body closure of our MSS candle, making this retracement our inducement. This one has more candles, one, two, three, four, five, six. So it's not just one single candle. It's still a proper inducement. So, so this other entry on BTC was on the 30 minutes time. This is it here. So this was it. MSS right here. This is the body closure of our MSS candle. The next candle that came out is this. See, it has multiple candles. Give us the retracement before price pushed up to break above the body closure of our MSS candle. The moment doesn't got broken, that's when I can now mark that retracement the market gave me as my inducement. This is the first MSS and the inducement. This is one. The second one that has to do with market triggering a zone that has a large body enclosure. When price hit this level, it took out this high, giving us what an MSS. After that, the body closure for MSS candle is right here, which means next thing you should expect is what an inducement, which is a pullback that takes out the body closure for MSS candle. Luckily, we had a pullback here, which is this candle wick, that proceeded to now go up and close above this MSS candle here, which means this pullback here is our inducement. So that is what an inducement is. the first valid pullback that market gives you after an MSS or after a multiple break of structure. Hope you guys are following me up. So the inducement is a trap in the market. It's a trap. The inducement acts as an extra layer of confluence that tells you that your MSS or your multiple break of structure is valid. If you don't get an inducement after getting your MSS, or you don't get an inducement after getting your multiple break of structure, like don't look for anything at that particular moment. You need to get your inducement after your MSS or your inducement after your multiple break of structure for you to pinpoint that your MSS or your multiple break of structure is valid. It acts like an extra layer of confluence at the same time. And then your points of interest are always below or above your inducement. If you're looking for buys, the point of interest, the zone you enter your trade will be below your inducement. And if you're looking for sales, the zone you enter your trade will be above your inducement. So that's the value, that's the use of the inducement. It's a trap in the market. The market will always come back eventually to take out your inducement and then trigger your point of interest. It acts as an extra layer of confluence. You understand? So that's what the inducement is for. So now, let's talk about the final topic for the night, which is one of the points of interest that we'll make use of. So we've talked about the structure, we've talked about the inducement. The next, let's talk about the point of interest. Now, there are about there are about 2 points of interest that I make use of in the market. About 2 points of interest. The first one is the order block. The second one is the breaker block. For this class, we're going to talk about the order block. In the next class, that's when we'll not talk about the breaker block and the rest. So, first of all, the order block is a zone in the market where there are a lot of institutional orders. The zones where the institutions, the banks, the hedge funds, those people that trade with the huge capital, it's just where they place their buy and sell limit entries. That's what your order block is. Now, there are two types of order blocks, the bullish order block and the bearish order block. The bullish order block is when you're looking for buys in the market, and the bearish order block is when you're looking for sells in the market. So, how can you identify this bullish and bearish order block? The bullish order block can be identified by a market giving you a bearish candle. The next candle will now be a bullish candle that engulfs it, covers it. Now, if it's the bearish order block, you see a bullish candle, then a bearish candle that what engulfs it. So if you're picking your entry for the buy, your entry will be from this demarcation, this zone that they meet, this demarcation of the order block candle here. So your buy will be, and your sell, and your stop loss will be below the last candles of the order block down here. And if you are looking for sell, your sell entry will be here, this demarcation with the meet, and your stop loss above this high of the order block candle. And then if your order block has the wick, if it has a candle wick at the entry side of your order block, for example, like this, if the wick of the other block is smaller than the body of the other block, this is the body here. If the wick of the other block is smaller than the body candle, then you can pick your entry from the wick of the other block right here. Same thing here. If you have a small wick on your other block candle, you can pick your entry from the wick of the other block. But the moment you have the other block wick extremely long, this is the other block wick. If you're picking an entry, pick your entry from where? From the body of the other block here. Same thing here. If the wick of the other block is longer than the body, pick your entry from the body of the other block down here. So it's now time to fuse everything together. So first of all, you identify the structure part of your strategy by getting either an MSS or a multiple break of structure. After that, it tells you whether you're looking for buys or whether you're looking for sells. Market was previously bearish here. I got the MSS here telling me that market is what reversing from this bearish move to the uptrend, meaning that it tells me that I'm looking for buys. After that, the next thing I'll look out for is my liquidity, which is my inducement, which is this first pullback I got before price took out the zone where the MSS candle closed. That means I've gotten my inducement. Yeah. Thirdly, I will now look out for my point of interest, which is my order block. So my order block is what? Going to be below my inducement candle. This is my inducement, it will be below it. If you look, you see I'm looking for buys. So the bullish order block, I'm looking for a bearish candle and a bullish candle that what engulfs it. This is where my buy is going to be for this trade. So I took this trade. I refined my order block because I've traded other blocks a lot of times. So I knew where to place my stop loss and price would not invalidate it. This was where my buy. Normally, if you are taking it, you will keep your stop loss below here just to be safe. But I've traded it well enough, so I knew where I kept my stop loss because I refined it. So it's going to be at the other block for the buy, so which is so I knew where I kept my stop loss, but you taking it for the first time, keep your stop loss at this zone that covers the entire other block. So this was the zone where I took my buy, this other block here. Eventually, price made all these movements, took out the inducement, and then triggered the other block. This was where the buy came from. This was exactly the trade. Eventually got three positions, and this was the full trade. But let me show you when I made analysis. Here, it was still fresh here. Eventually, so this was still it. See the same concept, price trigger. This was on February 6th. Eventually, price eventually triggered the trade. When price triggered this zone, I refined my entry and got refined the stop loss as well. This, so I had a smaller stop loss. So that was it. When price moved, I got another entry again. So because I knew the other block had a large body enclosure, I knew that it would give me another reversal concept below for more buys to come in, which was this reversal concept here. So I got the same trade, MSS, this candle inducement, and then the next thing I did was to get a pullback, was to get my other block, which is I got it from this time frame. I think 1 hour time frame here. I think around 2 hours. Yeah, here. So I got the MSS, the inducement, that's the pullback. So this can be my MSS, this can be my inducement on this time frame, which is the pullback I got, and then the next one is going to be the other block, which is the other block for more buys. This is the second entry. The same concept. That was how I got the second buy. So the first buy there, second buy here, which is this trade. So this was how I got the trades. So let's leave this particular one. Let's move on to the other examples I gave us previously, and we see how I was able to get the same trade. So let's combine everything again. So this first example, we had our structure, which is our MSS. We had the liquidity, which is our inducement. So because we're looking for buys, our point of interest, which is our other block, will be below the inducement. So this is the inducement. The other block will be below it, which is this other block candle. Okay. So the moment that price will eventually come, it will sweep our inducement and trigger the other block below the inducement. This was it. Okay. This was where this buy came from. Now let's talk about this one. Same thing. MSS, inducement, the other block below the inducement right here. So this was the buy from this trade. Hmm. Now this is the one for the continuation. So all these ones I picked is a reversal. The one for the continuation, multiple break of structure, inducement, other block below the inducement right here. Same thing here. MSS, inducement, other block below the inducement. This is the inducement, the other block below the inducement right here. So the moment the inducement gets taken out, target the other block nearest to the inducement. So this is just the basic introduction to the strategy. We're going to talk about more of this because sometimes you analyze your trade, MSS or multiple break of structure, inducement, and then price will never get your other block. There's a reason why, because the other block is not the only POI I make use of. I also make use of the breaker block, which we're going to talk about in the next class, alongside all the rules of picking a proper point of interest to avoid having missed entries for when you pick the wrong entry, or rather than the one you're supposed to pick. So, um, that's just this for the first introduction to the strategy. We're going to have much more introductions to the strategy. Someone's asking me why tie stop loss. I just told you how to place your stop loss below the candles of the other block that you picked or below your PUI. So the stop loss I'm picking is below it. Below this, I picked this stop loss right here. Yeah, it's because this is the other block candle. Here, my stop loss is below the other block candle. Where should I place the stop loss? Below the PUI that I picked as my entry. So, in the next class, we're going to talk about um more POIs, which is the breaker, alongside the rest of the rules of picking a proper point of interest in the next class. So I'm going to send the recording of this class once it's done processing, and I'll see you guys in the next class. Hope you guys enjoyed the session.